Winning at tax time isn't just about doing the work right before June 30. In this episode, we'll be unpacking tax strategies the wealthiest Australians use to save tax. Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are talking all things tax. It's that time of year when the questions start flooding in. How do I minimize my tax? How do I optimize my tax return? Earlier this week, we did an episode on our 7-step end of financial year tax checklist. We also spoke to Peter Nevill from Viola Private Wealth, how he takes his clients through that time of year. But in this episode, we wanted to do something a little bit different because tax planning isn't just about the end of financial year. It's about setting yourself up right. It's about the full 12 months. And so in this episode, we wanted to get Peter back in the studio, go a little bit deeper and understand how he helps his clients set up all year round to get the best tax outcomes. So Peter, thanks for joining us again here at Equity Mates.
Thank you for having me.
So today we're going to go through 4 strategies. We're going to talk about the right asset and having the right structure, tax-deferred investment vehicles, debt recycling, and franking credit recycling. Now, before we jump in, a huge thank you goes to Sharesight for supporting our tax series at Equity Mates. Sharesight makes tax time very simple, tracking your dividends, tracking all of your capital gains and capital losses, making it very easy to print out your reports and take them straight to your accountant. If you would like to sign up to Sharesight, head to sharesight.com.au/equitymates and save 4 months on a premium plan.
So Peter, we want to get into some of those specific strategies that Bryce mentioned earlier, but just to start generally, like how do you approach tax planning and tax structuring at Viola Private Wealth?
We generally try and keep it as simple as we can. So you've got certain structures available to you. Making sure you're getting the structuring right initially can do a lot of the heavy lifting in terms of that sort of tax minimization piece, but also that asset protection piece, all those sort of really key bits and pieces that go into someone's sort of holistic financial situation. Approaching the sort of tax planning piece starts really at the start with that structuring element, but then making sure that each financial year you're doing the super contributions piece, you're working through realised gains and what's available in terms of unrealised losses, looking to make sure we're paying as little tax as possible. But again, nothing wrong with paying tax. It means that we've generated income, we've generated growth, and you're in a relatively good position.
Yes.
Yeah, if you don't pay any tax in your entire life, you probably haven't done well financially.
So, Peter, do you notice differences in how some of your more wealthy clients speak or think about tax compared to, I guess, everyday Australians, Ren and I?
Yes and no. There's probably some added complexity there in terms of the structuring piece. But all the fundamentals are still very much the same. Ensuring that you've got the right assets in the right structures, ensuring that you're, making the sort of tax deductible contributions, making sure that you're, claiming all of your deductions that are available to you in whatever form that may take. So all the fundamentals are sort of reasonably simple, and so are the structures really. Like it's not as I suppose complicated as some people may like to make it.
Yeah, well, let's get into right asset, right structure. And Charlie, who's been on the show a number of times, he's previously spoken about how there's essentially 4 different tax structures in Australia: personal, company, trust, and super. So can you just explain how you think about those 4 structures and how you approach them in terms of getting the right assets in the right structure?
Yeah, so let's start with the most simple and the one that's probably the most appropriate for most people is just investing within your personal name. You're obviously taxed at your marginal tax rate, but if you're on a reasonably low tax rate, then it doesn't make sense to have any more complicated structures than that. If you're a member of a couple, investing in the spouse on the lowest marginal tax rate's name can make sense in reducing your tax. But ultimately, if you don't have really material amounts of wealth, then the costs of setting up and maintaining more complicated structures may not make sense for you. So that's the sort of personal bucket. Then we've got the trust, really just a flow-through vehicle. So it's just a legal relationship where you hold assets for the benefit of others. Each year, income and realised gains have to be distributed to someone, so they get distributed to the beneficiaries. If, for example, it's 2 members of a couple that are the beneficiaries of the trust, then you've got the flexibility to distribute as tax effectively as you can, which can be a really great benefit of that structure. Where you have each beneficiary above the sort of blended 30% tax rate, it can make sense to then distribute to a bucket company, which is our third structure. Now, the company will pay tax at a flat 30% rate. The important point to note here is that there's no long-term capital gains tax discount. So where individuals will get it, and even if you're on the top marginal tax rate, 47 including Medicare, then 23.5% is what you're paying a long-term capital gain at. Whereas if you distribute it to the bucket company, it's got to pay tax at a flat 30%. Now, the benefit of having a bucket company is that you can invest within that structure and retain the earnings. So where the trust has to sort of flow everything out each year, the company is able to retain it. The fourth structure is far and away the best that we have, which is superannuation. A tax rate, a maximum of 15% in accumulation phase, long-term capital gains at 10. But once you get into pension phase, everything within the fund, so all the earnings are tax-free, and everything pulled out of the fund is tax-free as well. So there's a real incentive to get as much into that bucket as you come to be able to access it, because it is the best tax structure available.
And so earlier on you said it's important to be thinking about these structures early and sort of making sure that you're getting set as appropriately as possible. When should you sort of say, okay, now's the right time, I should be thinking about this? Is it when you're just in the top tax bracket?
Not necessarily. And it's kind of how long's a piece of string.
Yeah.
So there will be a time where it will make sense. So even if there's a portfolio in your personal name that's got some unrealized gains, that you might just have to take your medicine and realize that and tip it into a trust with a view that then you're investing for a very long period of time beyond that, and ultimately the sort of tax savings and the flexibility and the costs of maintaining that structure will put you in a much better position than if you had have continued investing in your personal name. So it's very individual, and it's really sort of driven by the family dynamics and the position and the sort of asset base. But there's a real sort of exercise to get the right money in the right buckets over a period of time to reduce the amount of tax burden that there is.
What you said earlier about being mindful of like the tax advantages in different structures is really important. And the example you gave around, even if you're on the highest marginal tax rate, getting access to the capital gains discount means that it's often better to hold it in your personal name than in a bucket company. What about some of the other tax benefits? Like, can companies claim franking credits?
So much the same. So franking credits are just a refundable tax offset. So where a company pays tax at a flat 30%, if you've got a fully franked dividend at 30%, essentially it just neutralises it, and there's no tax payable. The great thing about refundable tax offsets is if you're, for example, in your personal name, you're on a low marginal tax rate, and you're below the 30% tax rate, essentially what happens is that money gets refunded to you as cash because the business has already paid the 30% tax on it, distributed it down via a dividend, and you reap the benefits of that tax already being paid. Very similar to superannuation. So if you get a fully franked dividend within superannuation and you're in pension phase, essentially you get that full franking credit refunded to you, in just a one-off scenario that just say you got one dividend for the whole year, which we would say diversify. But yeah, like that's the great thing about franking credits, especially in that superannuation environment.
Interesting. Can you give us some examples of thinking about the right asset in the right structure? Like, is there particular assets that just shouldn't go in super or in bucket companies, or is it doesn't really matter?
There is nuance to it. First and foremost, good investment decisions are the priority.
Yeah.
And then which asset sits within. If it's a bad asset, it doesn't matter where it sits. It's a bad asset. But for example, if all you've got as well is, you've got a bunch of retained earnings within a company, and then that's your investment vehicle, because you'll utilize that and then have to dividend it back out at some point and pay the top-up tax on it. So typically what you'll see in a company is more income-focused investments, where those growth investments, someone can pay tax at a lower marginal rate, whether it's on the top tax rate in your personal name or what have you. It can make more sense to hold it in that structure. The great thing about a trust is you can flexibly distribute. So you can distribute all the income to the bucket company. You can distribute the long-term capital gains to individuals and be able to optimize the tax in that manner. The great advantage of the flexible trust is being able to distribute where it makes the most sense.
Yeah, and you don't have to distribute the same amount every year in the same proportion. You can just have the beneficiaries available and then pick and choose as you
Correct. If one of the beneficiaries, for example, the couple have had a child and one of the partners is on maternity leave or paternity leave, and and they're therefore got far less assessable income for that financial year, you can distribute more and more of the income and capital gains to them than the spouse that's working. So it's not set in stone. You can change it every year as to what you distribute where. So whether it's capital gains, whether it's the income with franking credits attached, whether it's just, the standard income to the bucket company because it's 30%, being able to sort of have that flexibility is the real advantage of the trust.
Nice.
So I'm just doing my long-term tax planning in my head as we learn here. So I'm thinking like put most of my assets in a trust, and then any capital gains I make or capital losses I make, distribute them to me. But if I've got excess income, put it in the company. And then if I want to own assets that are like purely income producing, maybe put them in the company as well. Is that, am I getting the idea?
This is obviously general advice only.
Well, no, we're talking about me. We're not talking about the audience. And you don't know any of my personal circumstances. Yeah. Okay, no, that makes sense. What about things, and this is again just me thinking out loud, so it could be a dumb question, but for people who have investment properties that are negatively geared, do you need to hold that in like your personal name to get the benefit of negative gearing?
Yeah, generally, if you're on the top marginal tax rate, holding a negatively geared investment property would make sense
in your personal name. Yeah. So you wouldn't hold that through the trust.
If you held an investment property through the trust that had no debt to it, no sort of mortgage attached to it, then the flexibility to distribute the eventual gain would make sense.
Okay, yeah. But if it's got
you
a
can't
mortgage,
negatively gear.
Yeah. Okay, interesting.
Let's turn to some.
I want to keep planning my tax future.
This might help. I want to touch on tax deferred investment.
Okay, nice.
Outside of superannuation, so things like investment bonds, AMP, Generation Life, and the like allow tax-free access for sort of up to 10 years. How often and how common are these types of?
Sorry. Before we get into the how common question, I reckon can you give us a 101? Because I think there would be a number of people that aren't familiar with investment bonds.
Yeah, admittedly we don't sort of use investment bonds very much. Like they've sort of traditionally been for grandparents to sort of invest some money for kids' educations or something like that. But far and away, there's usually better options available. It's a tax-paid investment, so the maximum is sort of 30%. You can continue adding to it up to a certain level, but ultimately it's kind of a liquid. Like you can't really get it back without sort of having a bit of a penalty. Just in terms of the illiquidity, you'd rather be sort of rewarded for taking that illiquidity risk. And there's often better investment vehicles that you can use that will ultimately have a sort of lower rate of tax.
Like what?
Yeah, yeah.
Well, we've been through all four of them.
True.
Well,
That's interesting.
I find that interesting because you say an investment bond that you have to hold for 10 years is illiquid, but earlier you said super's the greatest investment vehicle, but that's more illiquid because depending on your age, like you might have to hold that for 40 years before you can access it.
Yeah, but it is also far and away a better tax structure. And that's the incentive, is to be able to grow that bucket as much as you can because
no capital gains on an investment bond after 10 years though.
But you've paid tax with 30% within it.
Yeah.
Whereas super is maximum 15. All the long-term gains are at 10 while you're accumulating, and then everything gets tipped into a tax-free environment that continues to compound. Yeah. The real difficult piece with superannuation is getting the money in that bucket. Obviously, there's restrictions around how much you can contribute. There's two sort of types. You've got the sort of concessional tax-deductible ones, which super guarantee payments make up a portion of, and then the sort of after-tax contributions that you can make. And generally, when clients are getting closer and closer to being able to access it, making those larger contributions can make more sense to get as much into that bucket as you can.
Interesting. So takeaway there is investment bonds are an option, but at Viola Private Wealth, not that common.
No, we feel there's better options for us and for clients than using those.
Nice.
Could you do a single asset investment bond where it was like almost like a startup investment or something that you was like not going to pay any income for the 10 years, but you wanted to hold it for a 10-year period and then you wanted those gains to be capital gains tax free? Like
you can go and explore that if you want to.
Again, I'm thinking out loud in this episode. Not something you guys do often?
No.
Okay. All right.
Nice. Well, we do want to say thank you to Sharesight for supporting this episode. If you want to take up a Sharesight subscription, head to sharesight.com.au/equitymates. Now, a common thematic that our audience love, Peter, is debt recycling. So firstly, can you just give us a one-on-one generally on what that is?
Yeah. So for example, if you had a primary residence with a mortgage against it, and you also sort of took out a line of credit or an investment loan secured against that property, then ultimately what you're doing is you're getting the dividends and income from the investments, tipping them into the offset account of the primary residence, which reduces the mortgage, and then you're drawing more out in the investment loan or line of credit. So essentially what you're doing is turning non-deductible debt into deductible debt.
Yeah.
There can be sort of risks attached with it, but that's the general sort of principle. Obviously making sure that you're able to service the level of debt and not get in a position where you need to sell assets at perhaps a bad time in order to sort of repay some of that debt. The servicing piece is really important, but where you've got sort of the protections in place and you've got sufficient amount in that offset account that you're not going to have to sell assets at a low point, for example, it can be a very viable strategy.
Yeah. So just to draw that out, when you say it's not for everyone and there's risks, are you saying like you pull all this equity out of your home and then it's deductible debt, but then you put it in the share market and the share market falls 30%, and then you've stitched yourself up in a big way?
Yeah, if you're unable to ride out the sort of downturn and sort of see the subsequent upside that markets recover, then you can get yourself in a lot of trouble, and you lose your job, for instance, and no longer able to service the mortgage and have to sell the property. All of a sudden, a lot of that equity gets chewed up because you have to repay the investment loan. So margin of safety is those, brilliant 3 words that Munger and Buffett.
That is a question we often get. How much equity do you need in a house before you should start thinking about it? Like what is that, margin of safety in terms of how much equity you want in the property and how much you want to leave in the property? It might be a piece of string question, but are there any general rules?
Yeah, it is a piece of string question. It's also probably a case of your risk appetite.
Okay.
How aggressive you want to be in seeking to grow your wealth. And if, obviously utilizing leverage, you've got the benefits of the upside if markets continue ripping, but you've also got that risk that, you're overexposed to any downside that you see as well.
Is it a popular strategy that you see clients doing?
Not particularly, no. So like where we don't need to, in order to meet a client's goals, we won't sort of recommend utilizing any debt. Very much what we want to do is just continue sort of, getting the right money in the right buckets and not blowing up any capital, that we can grow wealth to a point that, work becomes optional and we're able to fund lifestyle in retirement. We're able to sort of leave a legacy, give money to the kids, all those types of things. We don't want to be taking on undue risk when we don't need to.
Yeah, fair call.
Peter, we want to turn to one other strategy that I wasn't really familiar with and before we were researching this episode, franking credit recycling. So for people like me who hadn't really heard about it, do you want to just give us an overview of what it is?
Yeah, I'm not sure I've ever heard of franking credit recycling. I suppose, harvesting the dividends, for, some of the big blue chips who are paying fully franked dividends into an SMSF, for example. So the way that sort of franking credits work is that you get the dividend, then it's grossed up with the franking credit on top. You pay tax at your marginal rate, and then the franking credit acts as a refundable tax offset to directly offset tax payable. So obviously within superannuation, if you're in pension phase, your tax rate is 0. So what happens?
That's why they love it.
Indeed.
They love it.
That's why Bill Shorten lost an election over this issue. They love it.
Far out.
Indeed. And then obviously the franking credit then gets refunded as cash to the SMSF because the company has already paid tax on it. For double taxation reasons, you're then entitled to that franking credit.
Yeah, cash payout.
So we had a worked example here. An SMSF receives 70 grand in fully franked dividends, meaning there's 30 grand in franking credits, 30% tax rate for companies. So then in the pension phase where the tax rate is 0, they get a $30,000 cash refund. You can understand why people got politically motivated over this issue. Like 30 grand, that's so much money.
Got to be retired though. Got to be in pension phase.
Yeah. So is this, do a lot of your clients who are in that sort of age bracket, are they sort of structuring themselves and their investment assets to maximize the amount of franking credits they're getting?
Yeah. Look, obviously the investment outcomes are the first consideration. Also diversity. We want to make sure that we've got really good diversity in portfolios.
So you're not just all CBA.
No, so it's
that would have been pretty good.
That would have been good.
Would have been good last year.
Yeah. Will it continue to be good is the big question. Yeah.
But making sure we're not reliant on one asset class to do the heavy lifting.
Yeah.
It is a really sort of key piece of, especially a portfolio in pension phase, is having that franking credit exposure and having Australian shares exposure. But we still want to be utilising other asset classes that generate returns in a different way, so we're able to protect the capital over time as well.
Well, Peter, to close out, are there any other common strategies or underused strategies that we haven't spoken about or that you're seeing a lot of your clients asking for that, that we haven't touched on today?
Not particularly. It's sort of simplicity where it makes sense to be as simply structured as you can, and then utilising those more complex structures when it makes sense. But first and foremost, get those super contributions made where it makes sense to do so and claim those tax deductions.
Well, Peter, Bryce is a little bit disappointed because he had notes here that he was hoping you would talk about Cayman Islands and the Singapore sling down here. So he might have to ask you about those off mic.
No, I think the key rule is don't fall foul of the ATO.
They
take a very dim view on tax avoidance.
Number one rule.
Tax minimisation, not tax avoidance.
No, love that. Well, look, we really appreciate you talking us through it. I think there's a lot of complexity in this world, and I really appreciate your guys' philosophy of keep it simple. It's okay to pay tax and just minimize where you can and take the complexity out of it all. So we appreciate that.
Thanks for having me.
Thanks, Peter. And you can also keep it simple at tax time using Sharesight. Head to sharesight.com.au/equitymates. You can sign up and they will give you 4 months free on their annual plan. Platform that I use to track all my dividends, to track all my investments and make it easy at tax time. Sharesight.com.au/equitymates. But Ren, we'll leave it there and we'll pick it up next episode.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.